but we don't know what kind of yield curve that we are facing. It could make yield curve flatten. That could be the case. That could be the case. It could make this yield curve even more upward sloping. But anyway, we're estimating this 10-year T-note rate. Since the stock price, all the cash flow will happen in future. You have to incorporate it into your consideration. So, for example, if I were you, I would say, hey, expected 10-year T-note rate instead of current T-note rate. So I would maybe add 75 basis points to the current level, right? And the second measure is tips rates, long-term tips rates. You can pick 10-year or 20-year tips rates. And then, for example, tips rates 2.01% and plus long-term inflation. Long-term inflation. What's long-term inflation? You look at last 100 years. Something between 2.5%, right? That's your second guess, right? Or you can add the third guess. So for each parameter, you want to exhaust. You want to exhaust all approaches, right? And then risk-free, you have to make a decision. I mean, which one do you like the most? Some people say, hey, I like the first one the most, although I consider second and third one, right? That's no problem. And some people say, hey, how about I take the average of all three approaches, all two approaches. Better to have at least like two approaches, right? So in this case, you say, hey, this risk-free rate would be like the average, right, of the first two estimates, right? Let me see, that will be 2.63 plus 4, right? Two, 4, 5, 3 actually. 2.53, yes. Just a simple average, right? 3.2% risk-free rate, right? And then you move up to this active risk premium. You can arbitrarily pick one, let's say 6%, right? 6%. The higher bound, I mean, it's on the higher end of the historical risk, active risk premium, right? But you want to add a little explanation. Why do you think that? I mean, right now, market's kind of nervous, right? And the Federal Reserve is going to raise rates. We are approaching the end of bull market. I mean, there's so many bad things could happen. So you would expect a higher risk, equity risk premium would be more conservative. Of course, you can choose 5, right? But when you choose one number arbitrarily, you want to add a little explanation. Why would you choose that, right? And then you probably want to look at the implied ERP based on the current S&P 500 index, right? And we did that in chapter 7, and you might apply that approach, and you might want to get another table, right? Let's say implied ERP, right? So you might have several assisting tables helping you to get everything in this main table, right? And then third one is beta. Market approach, you do regression, right? You do regression. You found a stock return. And here you want to make a decision on how long would that be. Would that be daily data for a year? That would be 250 trading days, right? Or maybe 2 years, 1 year or 2 years. And then you could use weekly data or daily data. And some people use weekly data. That will be okay. Yes. Mm-hmm. Typically, when you do this project, you are trying to guess so-called a 12 months target price. So if you are aiming at getting 12 months target price, which is 1 year from now, you want to get a most recent beta. Most recent, 1 year beta. That would be more relevant. Although you could go as long as 5, 10 years, but the past beta, they changed. They change, right? But it is the most recent beta is more relevant to next 12 months. And some people do like a longer term stock price estimation, such as Morningstar. They do like a 5 year expected price. In that case, the beta that they use would be they would look at the past 5 year beta instead of 1 year. But here, let's say you are focusing on 12 months target price, then 1 year beta would be a matching fit. Yeah, very good question. And you can use daily data or weekly data. And most people do weekly data, yes. Yes. Yeah.
You would have to look at the actual trend of the company because a lot of stuff can be told by looking at the trend.
There's no method that will give you perfect estimation because even this market data is not that reliable, you see. So it's better to go a little bit further to look at this bottom-up beta as well, in addition to this market beta. Beta from your market model regression. And it will take a lot of work for you to do this bottom-up beta. Yeah, but it will be a huge plus to get a better estimation of beta. And when let's say you have two, right? You have two numbers here. They are different, but not very far away from each other. In that case, what beta will you use? You might take some average or weighted average. It's your choice. And let's say I take 70% weight on this bottom beta because it's more related to the fundamentals, right? But still, I take care of this market regression beta, right? 30% weight, or maybe just 50-50.
Technically, we can consider the market regression market beta
Yes.
as like a momentum beta.
Momentum, you want to be careful about that. Yeah. Beta changes over time. Yes, of course.
Yeah, if we look at the short term, for example,
Because the momentum is another concept. Yeah. That means stock return has a momentum when stock price have increased for several days. Then for the next day, it's more likely it will increase. That's kind of what momentum means. But beta is different. Momentum is used to measure return, stock price trend, but not something that you can refer to the trend of that beta. You see. So anyway, you got those three things. Once you get this beta, active risk premium, and risk-free rate, you can put everything here. Cost of equity. Cost of equity. All right. And then after that, you want to estimate the cost of debt. In this case, you want to look deep into financial statement of the company to see how many debt they have. And I think Capital IQ will give you a very convenient tool to figure out what is the average year to maturity. Year to maturity of the outstanding bond that a company has. Typically, there will be another table, right? They have, let's say, 10 different bonds. Each one has this year to maturity, that one, and you take the average, weighted average, typically weighted average.
All bonds or you want from certain date, from certain time to certain time? Because sometimes some companies have for long term.
Yes.
And others that are
Yes. And another approach is synthetic approach. You look at a credit rating of the company or synthetic credit rating of the company, and found the risk spread for that kind of bond with certain credit rating, and apply that as the cost of debt. And also, you want to take a look at the tax rate. That will be the effective tax rate, right? And in the future, you might add a little consideration of potential increase in corporate tax rates. Right now it's 20%, right? And it could be 25%. Right now, I mean, it's coming, yeah. It's coming, just a matter of time, I think. Yeah. But since cash flow of a corporation will happen in the future, so that's why you want to take that into consideration. Yeah, tax rates. And then after that, you look at the market value of the equity, market value of the debt, and to calculate the weight of equity and the weight of debt. And then you see, hey, let's say this cost of equity is from here, right? It's the equation, right? Risk-free rate plus beta times ERP. And then this cost of debt is from here, right? Cost of debt is from here, right? Right now, just a blank, right? And then you have calculation weight of equity and the weight of debt. Then you can calculate cost of capital. Of course, the tax rate as well. Right. So this is something that I want you to spend some time to complete it in the following week. Otherwise, you might need to do too much work during the last couple of weeks. Yeah. So it's really helpful for you to start things a little earlier. And since this is the teamwork, you might split certain tasks among team members. Let's say, hey, let me do this cost of equity thing, and how about you take care of that cost of debt thing, right? And once we get our thing done, then we can get together in this spreadsheet, something like that. Yeah. So this is a very important step for any stock valuation parameter build up. You see, so, there are a lot of tables. You might need to have like 10, maybe more than 10 tables to complete this structure. Once you have this, it will be much easier for you to. I mean, next step is to put all those things into your valuation model. Could be free cash flow to the firm model. Could it be dividend discounting model? In that case, you can, and here let's say you have another spreadsheet that is a valuation model. Then you put all those inputs, into that model. It will show you the answer automatically. All right. And in addition to this valuation parameter, you want to have another small table. That is the growth rate. Growth rate. How many approaches do we have in your hand? Historical view. You look at historical average, right? And typically you look at last 5 years, last 10 years, last 15 years. At least you need to extend that back to year 2007. That's the beginning of the business cycle. All right, to see what is the average growth rate. All right. So that's a historical perspective, but that's not enough. You want to look at reinvestment of the company. All right. So you have historical view, right? That's one. And the second one is the fundamental, which is related to reinvestment. At the time, you want to look into the most recent quarterly report or annual report to see what management says about the future reinvestment. And then you will look at the financial statements to see what capital expenditure was. what depreciation amortization was, so on and so forth, right? And this G equals reinvestment rate, right? RIR times ROE, right? And how do you get this RIR?
Divide the amount of money that made on the amount of equity.
CapEx minus depreciation amortization, right? Minus changing working capital. Right? That is the reinvestment, equity reinvestment, divided by net income. Right? That will give you this RIR. And then you look at what ROE looks like, right? That is net income divided by total equity, right? And then you get this estimation of G. That's the fundamental approach. And in addition to that, you really wanted to look into, Capital could give you a lot of information, and management is offering so-called guidance, earnings guidance or growth guidance. You can look at that to see if it's consistent with your calculation. And sometimes you want to look at other people's estimation. And S&P company actually does some kind of forecast, right, to see what growth rate this company may have. You can also look at their opinion, right, to see if there's a huge difference. If there's a huge difference, there's something might be wrong in your estimation, right? I mean, it's easy to make mistake. Let's say, if everything right, you will come up with like a 5.3%, but somehow you're getting like a 53%, just because you missed something, right? In that percentage calculation, right? 53%. If you blindly plug that number into a valuation model, you will see explosive stock price. So you want to double check against what management says, what other experts are saying. Yeah, those are people, reasonable people. Of course you want to do the double check. So that is build up your evaluation framework. That is I think the most important work. And starting this week, we are going to discuss how you put all those things into the financial valuation models. So you will get the estimation of stock price. And today we will address absolute valuation models or cash flow based models. There are 3 chapters. The first one is based on dividend, and the second one is free cash flow to equity, and the third one is free cash flow to the firm. And all of that cash-based valuation model, and the approach that all 3 methods use is cash flow discounting approach. You simply discount future cash flows, no matter it's free cash flow to the firm or dividend or free cash flow to the equity. Right? And the method-wise it's the same. You simply discount the future cash flows. Right? So that's what we are going to address. And once we finish this week and next week, then you will be able to, in your Excel, you build up the free cash flow based model, right? And valuation multiple based model, 2 alternative approach for you to get estimation of stock price. At that point, you are like 90% done with this project. All right. And regarding the structure of a typical stock research, what we are doing here is the most important part of valuation project. It's like the heart of the valuation of any stock. But when you write a research report, what's the purpose of writing a report? You wanted to convey your research to your audience. Who will be your audience? Your colleagues, right? Your boss, and most importantly, your clients. You see? So a well-written research report makes sense to most people, most educated people, right? And you don't have to make it extremely complicated. I mean, let's say you have research report, you show it to your dad, who is not majoring in finance at all, right? He can still understand what you're saying. You see, a typical research report follow a. I mean, no matter what kind of research report is, or who is making it, what company is making it, it typically have very similar structure. Or they contain similar items, very important items in the report. Right? So the report any report start with your opinion. Right? It's a recommendation. You show a recommendation at the very beginning. That's the conclusion. Right? Typically one paragraph. Are you gonna recommend to buy or sell the stock, right? What's your estimated stock price? What's the current stock price? There's a huge gap. You see, okay, that will be a buy recommendation or sell recommendation. Meanwhile, you add the most important thing in this report, in this paragraph. Right? You tell them, okay, we are getting this target price of such. What method do we use? Right? What are key assumptions that we used? Right? What's the strength of the company? Right? But just the one paragraph. And followed by description of the company and stock. You say, hey, stock, company, they are the same thing, but actually it's not. Company is the business. Right? Stock is stock. When you describe them, it's different. When you describe company, you talk about, okay, what kind of business they are doing, right? How many business units do they have? How many people do they hire, right? And what's the geographic distribution of their operating facilities, so on and so forth. What's their key competitive advantage, so on and so forth. That's description of the company. When you describe a stock, you typically use numbers, right? 52-week high and low. The most recent stock price trend, right? Let's say 1-year trend or 2-year trend, right? And what is the trading volume average, right? What is the most recent P ratio, so on and so forth. It's a very simple statistics of the stock. Here you see the difference between stock and a company, right? And then after that, it's called investment summary. Investment summary just extended discussion of this recommendation. Why do you think this is a buy opportunity? Right, in your recommendation, we see very brief description, but people want to get a little more details. Right? And here you have several items that you want to discuss, but typically a couple paragraphs. And some people use it like a bullet points to highlight. Right? The rationale supporting, right, a buy recommendation or sell recommendation. That's called investment summary. Sometimes people call that a thesis, investment thesis. Thesis is too long, right? Like a 50 page or 100 page. But thesis, investment thesis, typically less than 1 page or half page. Typically half page, I would say. Yeah, 2 or 3 paragraphs. That is most important part. I mean, visually, from your audience perspective, right? They're getting very concise, opinion from you. That's conclusion. But they want to know more. Okay, look at this, right? That's on the second page, typically on the second page, right? And okay, if they want to know more, okay, then let's go on. After this investment summary, what do? You are going to show two basic analysis. The first one is historical comparison. Or we call this as a financial analysis. What does the financial analysis do? Financial analysis actually do historical comparison based on those financial informations. Typically, okay, right now is 21, right? And actually, what you have is first 3 quarters in 21, right? And then you look 2020, 19, 18, 17, 16. At least people look at a 5-year trend. And in this case, you might extend it to 10 years, right? 2011. But some people say, hey, how about we look at it a little further to year 2007, so we see the full picture of this business cycle during this expansion. That's no problem. But typically 5, 10, or 15 years. Typically 10 years, because a typical business cycle covers 10 years. But you can make it a little longer or a little shorter. That's your choice, right? No matter how long the range is, typically 5 years minimum. So you can call this as historical analysis. And then you look at some key financial items. There are three financial statements, right? Balance sheet, income statement, and a statement of cash flows. And you want to put some important numbers here, not all of them. All right? You put, let's say, in the income statement, what number do you need? Sales. All right? EBIT. Net income. Those are the most important things. Your audience want to look at, right? And for the balance sheet, what do you want to put here? Total assets, right? Total debt. Yes. You pick. Not too many, but not too less. Typically, I would say between 5 to 10 items will be good. Yes.
What about the number of shares outstanding?
That's here. The current number of shares outstanding. Description of the stock, just right now.
But on a history.
History is more on the financial statement, financial analysis. And then for the cash flow, let's say cash flow from operation, all right? And in addition to those accounting items, you want to add some percentages there. Important financial ratios. You might find more than several dozens of financial ratios in Capital IQ, but you want to put the most important ratios here. What are most important ratios? ROA, ROE. Those are extremely important ratios because those measures how profitable a company is. Debt ratio. You see, debt ratio is very important. It shows the financial leverage of the company. Capital structure. Right? So I would say, around 10 items that will be sufficient for your clients to see a big picture of financial condition, operating performance of this company during the last 10 years or so. All right? And then you wanted to, since you read the most recent quarterly report, you want to discuss a little bit, just 1 or 2 paragraphs, to see if there's any improvement or decline in the operating performance. That's so-called financial analysis. And some people actually do pro forma financial statements. Pro forma means forward-looking financial statements. So you are making like financial statements for year 2022. Because it hasn't happened yet, but you want to make forecast what those numbers would look like, right, based on your estimation. Yes.
So for the investment summary, basically, we're just going to kind of summarize what we pretty much did in our Excel, basically just explain it to everybody, like we want
Yes.
buy the stock.
Yes. The rationale. It's an explanation of the rationale of your recommendation.
But
It's
anybody can understand that basically. It's like
yes.
kind of just tell them like, hey, this is what our project we're leaning towards in this.
Yes. But it's more. It's not about about this opinion.
Yeah.
Yes. No. Yes. What the stock price do you think is right? Yeah. And then pro forma statement is pretty common component of any financial research report. How many of you already took 6710 class? It's called Modern Finance Application or Excel class? Excel. Yeah. Yes. All of you took that. Okay, that will be easier for you guys to use pro forma. Right? You already did that in that class. And that would be, I mean, for financial analysis, that's three items. First one is this, historical comparison. And the second one is most recent quarterly report discussion of those financial ratios. And then the third item is pro forma statements. And for pro forma statement, I only need income statement. If you want to add others, that's okay, but I think income statement will be sufficient. The pro forma?
Yeah.
That sounds familiar.
That was kept
Yeah, I
corporate
remember
finance, yeah.
But yes, that was Dr.
So
Jensen.
pretty much we're looking at our, it draws a projected,
Isn't that like the French
increase in
data?
tax or
Yeah,
whatsoever. And then we're making the 2020 based on that.
Okay. Okay.
Yeah, we did it in the capital issue.
Okay.
Yeah.
Yes. 4.2 is quarterly report. Discussion of the most recent quarterly report, focusing on operating performance, reflecting those financial ratios. Right. Why do we do this? Financial analysis. Because the thing that we do here offers, for example, this one from here, you're offering the clue to how you get that growth rate estimation. From here you see historical growth rates, right? And from here, you will get EBIT estimation, right? If you have free cash flow model, you will have this EBIT, right? Starting point for you to estimate free cash flow to the firm for next year. Next year means 2022, right? This 2022. You see? So all the things actually are helping you to show the audience why you are getting certain numbers in your financial valuation model. You see? They link to each other. And all you do here is offering supporting foundation for the number that you put in the Excel spreadsheet. Right? And after this financial analysis, that's kind of horizontal analysis. And then you do peer analysis, peer comparison. You compare this company with its main competitor in the same industry. Same industry, right? And typically you wanted to have a table like this. Company A, B, C, D, right? In the same industry, and then you want to do a little average calculation here. And here's some key financial matrix. Could be market cap or market value of the company, the size that shows the size of those competitors, right? Sales, right? ROE, profitability, right? And P ratio, valuation multiples, right? And you want to, put some items here showing the how good this company is compared to its competitors. And here you want to add some discussion on how this company is building up its competitive advantage. Right? So here you can incorporate your reading from this quarterly report and annual report. I mean, management discussion of this corporation strategy will give you a lot of clues, right? How this company is building up its competitive advantage to go against their peers. Right? And also you want to discuss the growth strategy of the company. What did the management say about their near future expansion strategy? How many new stores would they build? How much money did they put in this capital expenditure? I mean, you want to see. I mean, not something that you think of, right? But you get it from what management says, what analysts saying, or you want to link the number with fundamentals, link the number with the reality. In your Excel, all those things are numbers, but those numbers need to be supported by fundamental. But here you need to distinguish. When you talk about fundamental, there are several different things, right? You have to distinguish the facts from your opinions. Anything happened in the past that is facts. But most important thing, no matter it's number or discussion, actually in this report is kind of opinion. Right? And a good research report will give people a very clear picture, right? They will see how reasonable your opinion is. And those opinion is strongly supported by some facts and reasonable analysis. That makes a stock research a very strong. And after that is the most important thing. Valuation. Valuation parameter build up. Right? And the models do you use? You use in this analysis. Cash flow based model. Valuation multiple approach. 2 of them. Right? And the last thing is called investment risk. Investment risk, talk about what could go wrong you recommend to buy. Yeah, you think, right now stock price 100 and your estimation 180. That makes a strong buy recommendation because you see the gaps like 80%. That's pretty nice, right? But what if you are wrong? You could be wrong because all of the things are based on opinions. So this investment risk actually consider what could go wrong. that will make stock price won't get to that point in the future. And here, some people do so-called sensitivity analysis. Sensitivity. What if my estimation of this cost of equity is wrong? And the cost of equity, my estimation is 8.5%. What if I'm wrong? Well, through the sensitivity analysis, you can see how wrong it could be. Right? Stock price will change to this range if cost of equity go up to 9.5% or go down to 7.2%. Right? And I think Excel class also teach you how to do that sensitivity analysis based on some key estimation like cost of equity. What else? Growth rates. Growth rates are a very sensitive factor. Yeah, that will lead to big swing of stock price. Right. If you do two-stage model, then yeah, what do you think? Yeah, the next 5 years gonna have this much growth rates. Yes. And then last part is about the what could go wrong. It's called investment risk. Right? And then people say, hey, yeah, you consider all those black swan events. It could happen, but it's kind of events with low possibility. Right? But it could happen. So in the future, if your recommendation goes bad, okay, you can say, hey, something happened here. I took that into consideration, right? And you know that, I know that, you know that, so I'm good, you are good. You see? But if you ignore that, people will blame you. You said it's going to be $180, but right now it's 18. What happened? All right. So you want to, give yourself a little break, but you want to, sometimes bad things could happen, Multiple bad things happen. I mean, it's not your fault. I mean, everybody suffers, right? It's not about but you need to specify what could go wrong. This is the hard part, I'm telling you. This is a really hard part. And that's what a typical stock research look like. And once you get everything here, you are good to go. But you're not a great financial analyst yet. The great financial analyst will look into, the recommendation. If you say buy, right? If you say buy, that means the market is wrong, you are right. That's a pretty big statement, right? What does market mean? Market means an army of smart people. Right, 10,000 smart people that are trading, they put money on the table. They do very diligent analysis, and you say they are wrong, and you're right. I mean, you need to be careful. So, for a great analyst, you are able to tell what's the difference between you and a very, very smart army of financial analysts all on the market. All right? What's in the stock price? What's not? Your recommendation must be built on a very unique perspective that the market is missing. The entire army of financial analysts are missing. That is hard part, I'm telling you. That is a hard part. That's first thing. And the second thing is, you said my estimation $180. Right now, $100. You're going to tell people what will be the trigger. What will be the trigger that will bring the current price to your target price? All right. And the third, you think about this, what could go wrong very, very seriously in a more depth manner. What could go wrong? Right? You think about every sensible estimation, especially like a G. What could go wrong on this G? What could go wrong on this cost of equity, right? What could go wrong? And lastly, you want to have the consistency of your analysis. So many different pieces in this puzzle. Once you put them together, you know the consistency between different components, and you can show your audience in a very convenient way, so they can see the logic. They can see the logic of your analysis. And finally, you know deep in your heart how many factors in this analysis or research for. You might mention more than 100 different things, right? And all those things contribute to future stock price changes. But you know, for this stock in this very specific industry, I can filter those 100 different factors into less than 3, which is the most important factors. Most important factors. I would monitor for the next week, next month, next quarter, next year. Those are most important factors, right? That will affect stock price. And I keep close eye on it. Every time it changes or I see the future trend or something is gonna change, I'm going to update my research. I could be wrong, no problem. But if you can correct it on the continual basis, man, you will become the expert. I mean, typically people update their research on a quarterly basis because every quarter the corporation is giving you a chance to double check. I would say reality check, right? You said last quarter that our company is going to deliver this much sales, this much earnings. And now we are going to show you what real number looks like. It's like a reality check, right? So reality check happens on quarterly basis when company release earnings. That's why financial analysts, they update their research on a quarterly basis. Right? So I think I talked too much about this evaluation project, but I think once you've done a evaluation project successful in this classroom, you have plenty of opportunities to take a lot of different types of job positions. You can work for corporate, you can for investment bank, you can be financial analyst focusing on equity research, or you can be a bank manager analyzing the credit quality of a company or your clients. And more importantly, the training that you are going through in this class will help you a lot in the future. Yeah. Consider things from different perspectives, right? And exhaust all the possibilities to address details of certain issues, right? So that's a little actual discussion, and I think we haven't done anything today yet. So let me start the chapter. So after the first exam, I would say you can relax just a little bit, just a little bit. And you might underestimate the thing that we are going to go through before the second exam, because we'll have 6 chapters to go through, right? Right now, 3 chapters, cash flow based models, and 3 more chapters based on valuation model. But you say, hey, I already learned all of them in my investment class when I was an undergraduate student. And actually, I would say the most thing that we discuss in those chapters, you probably know something about it. But the most important thing that we are going to do, right, for this week and the next week is we are going to put everything into Excel spreadsheet. And previously, all of the math, you know all of the math, but right now we are going to make it useful, make it practically useful for you to come up with stock price estimation. All right. Okay, chapter 13 is about the dividend discounting model. Dividend discounting model is starting point for stock valuation, and you know stock price equals dividend for the next time period divided by the difference between cost of equity and the growth rate. And this based on very simple assumption that a company will have a constant number for future growth, which is horribly unrealistic. Right? But this equation offers you a great tool to understand the most important determinants of stock price. 3 determinants. Cash flow. First one, cash flow, right? And here it's in form of dividend. And discount rate and the growth rate. 3 things. 3 things, right? And it's more it's more on the theoretical framework, showing you, determinants and direction of the impact on the factors on stock price. Let's say a discount rate. What's the direction of the impact? It's negative. High discount rate, lower stock price. What about the growth rate? It's positive, right? And actually, it's a very powerful determinant of stock price. Higher growth rate lead to higher stock price. And fundamentally, it is the cash flow, right? However, this model, I would say, is not that useful, and I agree, because you cannot use this simple equation to evaluate, let's say, more than 99% of companies on the stock market. However, there are some exceptions. You might find some exceptions. You can still use a very simple model to get a very, pretty nice estimation of stock price. Right. And this dividend discounting model, you can use it, but with limitations. And here are limitations. You can apply dividend discounting model to the company with stable growth. It's not good for smaller companies. Medium-sized companies, small company, no good. And because they don't pay dividend. Simply put, they don't pay dividend. They need to grow, right? They don't pay dividend. And second, the company that pays out dividend that are high and it's about the equal amount of free cash flow to equity. They distribute most of the free cash flow back to shareholder in terms of dividend. And the third one is the company tend to have stable leverage, and that leverage is typically high leverage, but stable leverage. And the last one, the beta, close to 1. So who are good candidates? I would say those large corporations. Large corporations tend to have stable beta, close to 1, right? They have stable growth. Large companies. Large companies tend to have relatively higher leverage, but leverage kind of stable. They don't change drastically, right, year to year. And a large company, since they don't have much room for growth, therefore they distribute free cash back to shareholder through dividends. Right? So that's the feature company that can use you can use this dividend discounting model. And here are candidates. 3 typical candidates for golden growth model. Golden growth means constant growth model. Just three factors in the equation to get the answer. First one, regulated companies. regulated companies like utility companies. It's local monopoly, they don't grow, right? And they have stable leverage, stable dividend, right? That's one good candidate. And the second candidate is large financial companies. Large financial companies like Bank of America, JP Morgan, so on and so forth. And the third one is the real estate investment trust. Because so-called REITs, they invest in residential, commercial real estate properties, and they collect rents. And once they get a cash flow, they're supposed to distribute all of them, virtually all of them, back to shareholders. So they won't be taxed. I mean, REITs are tax-free as long as they distribute more than 95% of the earnings as dividend to shareholders. Right? So three great candidates for you to utilize this golden growth model. Now let's take a look at one example how we can utilize this golden growth model. Con Edison, a electrical utility company back in year 2006. Right? First of all, you want to verify this is a good candidate that we can use this model. The company is in stable growth based upon size and area it serves. Its rates also regulated. I mean, you won't expect huge revenue growth from a utility company because the price is regulated. Price is highly regulated. It's unlikely the regulator will allow profits to grow at extraordinary rates. And the beta is low and close to 1. Beta is 0.75 and it's been stable over years. The firm is in stable leverage. Leverage ratio is high but very stable. And the company pays out dividend that's roughly equal to its free cash flow to equity. Right? And then you look at free cash flow average in the last, 1991, 1998 is $480 million US dollars. Dividend $461 million US dollars. Dividend as percentage of free cash flow to equity is about 96%. And then you look at earnings, dividend payout ratio, dividend per share, expected growth rate, and a beta. Right? And here, you estimate cost of equity first, risk-free rate plus beta times equity risk premium. That give you about 10% cost of equity. Right? And then, where do you get that dividend? Dividend is from earnings. You look at earnings first. Right? 1995 is D0, so 1996 D1. And you look at dividend payout ratio. So you get an estimate of dividend. Right? And apply this growth rate, you are getting D1, dividend for next time period. Divided by the difference between cost of equity and the growth rate, you get estimation of stock price, $41.80. Once you get this, you compare with the market price. Market price was 30. Man, you're too optimistic. This is the risk-free rate. Back to 1995. Yeah, back to 1995. So here, what could go wrong? It's unlikely that dividend payout ratio or earnings or dividend will be wrong. The growth rate, right? That is the most sensitive factor in this model. And actually, you can figure out what is the market consensus on this growth rate. You think it's 5%. But what market think is 3.12%. Right? So Actually, if you apply 3% growth rate into this model, you're getting something that's very close to the market price, which means the model is pretty good. Pretty good, right? And so what's left here is to verify if this 3% is a reasonable estimation. All right, so that's a constant growth model. And let's look at another example, JP Morgan, large financial service company. Large financial company, I mean, like JP Morgan, Bank of America, I mean, they don't have much room for future growth. Why is that? They're already big. The market is fully penetrated. All right, so not much growth left there. That's why a lot of banking company has a low P ratio, because they don't grow much. Right? And as financial service company in an extremely competitive environment, it's unlikely JP Morgan earnings are going to grow much faster than economy over the long term, allowing for expansion. The growth rate used is 7% at that time. As a financial service company, free cash flow to equity is difficult to estimate. Therefore, using dividend could be a better approach. And the leverage of financial service companies is high and unlikely to change over time. The leverage is high, very high. For financial leverage, I mean for banks like JP Morgan, typically, if there's a $1 of equity, they might have $10 of debt. And that ratio is highly regulated by the Federal Reserve. Right? You cannot take too much debt. I mean, you could take much less debt you want, but that will reduce your competitive advantage. You want to maximize the money that you can borrow as a bank, because your business borrow money, right, at a low cost and lend it at a higher cost. You want to have as much money as possible, or as much debt as possible. But there's a ceiling, regulated ceiling. So bank is a good candidate, and let's say current earnings $6.30, dividend payout ratio 47%, and dividend per share would be $3. Expected growth 7%, stock beta 1.15, and from there you can get estimation cost of equity, right? And then you apply this model, simply will give you about $60 target price. But at the time, the JP Morgan was traded at $80. What could go wrong? I would say this growth rate could go wrong, right? This growth rate could go wrong. It could be higher. Yeah. Maybe you should try like 7.5%, 8%, something like that. But anyway, this golden growth model is still useful model for you to deal with large banks, utility companies, and REITs. And we have another example showing you how to estimate S&P 500 index by using this dividend discounting model. The rationality here is when you combine 500 companies together, you are getting a huge company, right? And this huge company doesn't have much to grow. It will grow with the GDP growth, right? So it's the most mature company when you combine all 500 companies together within this S&P 500 index. And we look at average dividend yield, 2.32%, and the level index 611 back to 1960s and 1996. T-bond rate 6%, expected growth rate in the nominal GDP 6%. And the level index can be obtained from golden growth model. That is, let me see, dividend per share, right? Dividend yield times the price level, right? It's about $14. Multiply that with 1 plus the growth rate 6%, right? Divided by R minus G, that give you 273. Wait. The index like a 611 and I'm getting 273. This model is bad.
We know that that's gonna be a
I mean the gap is too big. I mean to justify this model, right? But here is one actual thing that you need to pay attention to. That is this dividend. This dividend is underestimated because a lot of companies, especially those large companies, they distribute cash flow not only through dividend but also through stock repurchases. And here, the reason why you're getting some ridiculous numbers because you missed that part. That part actually is big. Stock repurchase. In a stock repurchase, stock repurchase is about like 1.2%. 1.2%. So your dividend yield 2.3%. And then when you add that stock repurchase into this dividend, you're getting 3%, right? 3%. And then you replug that number into your equation, you will get a much more reasonable estimation of the S&P 500 index. But still, you're using this golden growth model. And for the entire economy, for S&P 500 or for large financial companies, and I think this model makes sense. Why that? Even when economy fluctuate, even when like a large company, I mean banking company, when it goes through the business cycle, you will see huge fluctuation of earnings, right? But still, we can use this constant growth model. Why is that? Economy goes up, goes down, goes up, goes down, goes up, goes down, right? This is the first business cycle, second, third, so on and so forth. Right? And if you can step back for 100 feet, right? And take off my eyeglasses, I essentially see a roughly straight line like that. Right? So that justifies why you can use golden growth model. I mean, they go up, go down, go up, go down, but when you combine them all together, use a constant growth model. I mean, everything smooths out as long as it's a large company. Right? And sometimes you want to use two-stage model. Why is that? All right, let's say, hey, this is the economic recession, and right now economy is going up, and right now we are at this point, right? Let's say, year 2009, we are at this point, right? In this case, I think it's reasonable to apply a so-called a two-stage model. Because we expect that this economy is going to expand. That's definitely happen. Will definitely happen. A recession is almost over. The economy will expand, right? Typically, 2 or 3 years of recession and 7, 8 years of expansion. So you would expect even a mature company will have a higher growth rate during this expansion. Especially when this company is cyclical company, like a banking company. Right? But after this, beyond this, then you look at this. And look at this, I mean, it goes on, goes up, but roughly it's a straight line, and you can apply a constant growth rate, a low number of constant growth. Right? So if you are in the middle of the business cycle, you're good to go. But if you are too low, then you want to use two-stage model. Or if you are too high, then you want to make another adjustment.
So technically for our model, we rather use two-stage model.
In most cases, people would use two-stage model. Really depends on the scenario because when you look at a past research report during the last 10 years, I would say two-stage model is reasonable. Right? We are in the middle of the bull market. Let's say back to year 2011, year 2010, year 2000, even it's year 2016, right? Still, this bull market hasn't completed yet. But at this point, I think we are somewhere here. You see, we are facing a downward like this. Wait, year 2008, 2022. It's like 14 years already. You might say, hey, we need to consider include year 2007, right? That makes 15 years. And actually, the true economic recovery, I mean, people argue is not year 2019, but year 2012. But even year 2012 to 22 is already 10 years of expansion. I mean, expansion, I mean, can continue, but you just cannot have expansion that will last forever. Somehow, I mean, there will be correction, there will be slowing down, or recession, I mean, something like that. Right? So, when you do valuation, you really need to keep that in mind. Yes. Yes.
So technically, we will have the recession if compliance is taken. If all the analysts will decide that there's about time when we have to use the two-stage model and reevaluate, and because the market is the wisdom of the crowd, when the analysts, all the analysts will realize that we're in a bear market right now, pretty much, they will reevaluate the model, and that will trigger basically the bear market because they will reevaluate their model, they will adjust their targets, price targets, and that's exactly what's going to happen. Right?
And actually, that could happen. However, there's always a reality check. They will bring back into a rational situation. For example, people say a tech company is overvalued, but Google says, no, they are not. Look at my earnings. Very strong, right? And people say, okay, let's continue on this tech knowledge bubble. But today, Facebook, I mean, down by like 25%. Yeah, that was 26%. That was crazy because they had not that optimistic outlook, right? If you say, hey, you made a mistake, that was a huge mistake for you to change the name from Facebook to so-called, I cannot even, I cannot even remember that name. It must be bad, right? It might be a bad strat. But the expert says it's not that name change just because the Apple, I mean, the cooperation between Facebook and Apple is no good. But the relationship between Google and Apple is very good. So that explains, I think, yeah, that's reasonable. Yeah. And okay, anyway, one-stage model is still useful, but more frequently people use two-stage model. People use two-stage model. Let's take a look at one example using two-stage model of this dividend discount model. The target company is American Express, the credit card company. So we need to do a little reasoning why two-stage model. First of all, American Express, a large financial service company in a very competitive marketplace, normally not a candidate for above stable growth. It has gone through extended period of depressed earnings. It expects that the recovery in earnings will create high growth over the next 5 years. That's pretty common for any financial companies coming out of recession or economic slowing down, right? And you will see very strong recovery. So two-stage model is a very suitable model for that kind of situation. And why using dividend-based model? As a financial service company, free cash flow to equity are difficult to estimate. So dividend is a better representation of cash flow. And also company has a very stable leverage. So that makes American Express a good candidate for two-stage dividend discounting model. And then we look at some detailed information. You look at earnings, dividend, and estimate the length of high growth time period. Right? 5 years, that's pretty reasonable for a company coming out of distressed condition. 5 years of strong recovery growth would be expected. Sometimes it could be 7 years, but anything beyond 10 years, it's hard to be. You can make that assumption, but it's hard for you to convince your audience because typical length of business cycle is about 10 years. Right? So 5 years in the middle, that's kind of reasonable, right? Conservative, reasonable. And then you estimate cost of equity, beta 1.45, equity risk premium 5.5%, very neutral, right? Not very high, not very low. 5.5% is kind of neutral. 6% risk-free rate, that gives you about 14% cost of equity. And then return assets, 14.56%, dividend payout ratio, and the debt ratio, and also you look at interest rates on debt. Expected growth can be estimated based on ROA. Or you can get ROE directly, but it will be the same. So your estimated growth rate would be something a little less than 17%. Once you get those inputs, then you can put into a very simple equation. Actually, it's easier for you to put things in your Excel spreadsheet, right? 5-year high growth. You start with first year, right? Of course, there'll be year 0. Sometimes people will put a year 0 in the first row, then start with 1, 2, 3, 4, 5, and then you do calculation on EPS. When you apply growth rate, you can do automatic calculation here in Excel, right? And then DPS is dividend per share. You turn this with payout ratio. You turn this payout ratio, you get dividend per share, and then you discount using the equity cost of equity 14% to discount those individual dividend. You get the present values of discounted dividend for the next 5 years, which will have high growth. That's first stage. And then second stage, you calculate the terminal value. Terminal value starts here. Actually, 6 years is the first year of your terminal time period or stable growth time period, right? And you start with this 6.74 multiply by 1 plus the low growth rate or constant growth rate in the terminal time period. And then divided by cost of equity minus the low growth rate. And the low growth rate is let me see. Yeah, 6%. 6% is the low growth rate. Yeah, expected earnings, expected dividend. Right? Expected dividend is $4.95 divided by R minus G. R minus G. And notice that this R is different from the previous R. Previous R is 14%, 13.98%. And when a company goes from high growth time period to stable growth time period, you would expect the company will carry lower risk. It becomes more mature, right? So the beta would be lower. Right now, it grows aggressively. The company is supposed to be more risky. But in the future, in that stable growth time period, it's supposed to be more stable. Therefore, beta is supposed to be lower. So we take that into consideration. So when you do terminal value estimation, this discount rate is different. It should be lower, reflecting lower beta and the lower risk of the company. Right? So then you get the terminal value estimation, but do not forget to discount this terminal value to present value. So this is the second stage value, and this is the first stage value. When you put them together, you get the stock price estimation. Two-stage model. Right? In your investment class, undergrad investment class, this discount rate is same as the previous discount rate. It's the same. But actually, it's supposed to be different. Why? Because in constant growth time period, companies should have lower risk. Right? So in your valuation model, make sure you understand that those two numbers are supposed to be different based on different beta. In the constant growth time period, we expect that the beta will decline towards 1. And currently it is beta is 1.45, you see. But getting into constant growth time period, you would expect that beta will go down towards 1. Not necessarily equal to 1, but towards 1. Should be much lower. And here assumption is 1.1. You expect that beta will decline from 1.45 to 1.1 when entering into that constant growth time period. Let me see what else. All right, so that concludes chapter 13. Let's take a short break, and we'll be back introducing free cash flow to the firm model. Yes, next week. Uh-huh. Uh-huh. There are specific that you can, yeah, send me email. Yeah, tell me which question you have, what kind of issues. Yeah, then we go from there.
how can I forget? You have a bingo daughter-in-law. Could be daughter-in-law.
Okay, let's continue our class. Before we move to next chapter, let's take a short review. The chapter that you went through online last week, which is chapter 9 and 10, it's about earnings and from earnings to cash flows. And in chapter 9, there are two very important issues for us to address. That is research and development expenses, as well as lease commitment. And let's take a look at the first one. It's called R&D. R&D is required to be treated as expenses. However, in its nature, R&D builds up the long-term assets for the company. Although money has been spent, however, it will benefit company's future. Right? So essentially, R&D builds up assets, not the expenses. But the GAAP, generalized accounting, acceptable accounting principle, actually requires company to treat R&D as expenses. Right? So the consequence is earnings that you see where a company has a large amount of R&D is underestimated. It's underestimated. So we needed to make certain adjustment in our financial analysis. How? First of all, we need to figure out the assets of R&D. And the second, we need to make an adjustment on earnings. That's the income statement item. And the third one, we need to make an adjustment on the balance sheet, which is the assets. Right? So the first adjustment is on the balance sheet, equity. We need to add back the value of research assets because previously it's been expensed away. However, we need to add it back. It is the research assets. It's kind of intangible assets, not fixed assets, but intangible assets. And the second adjustment is on EBIT, earnings. How do we do that? EBIT plus this time period's R&D minus the amortization of the research assets. That's the second adjustment, which is very important. Because previously the EBIT tend to be underestimated. Right now you're going to make the right adjustment. And the third one is net income, of course. It's the same as EBIT. And also assets in the balance sheet need to be adjusted. So essentially on your balance sheet, that's assets on your left, right, and debt plus equity. So here you needed to add that R&D assets right? And here you have R&D assets at the back. So the balance sheet can be balanced. And on the income statement, you make an adjustment on that EBIT and the net income, right? Sales minus expenses, right? Equals EBIT minus interest, EBT minus tax, that give you net income, right? And the problem is this R&D is in this expense. Therefore, we needed to add it back. Add this back. But still, these research assets are aging, therefore you need to minus the amortization of the research assets accumulated in the company.
So if we didn't spend it this year, not amortization for this year,
This year.
this year's one.
I would say the most recent quarter or most recent year.
So they reported earnings this quarter, and they had a 10 billion invested in the metaverse research and development, and that obviously affected negatively.
Of course,
earnings.
you will see negative earning, right?
Yeah.
And actually, you need to add that back. But still, since company do this every year, you see, and then you need to the illustration 9.2 showed you detail on how to treat this IND. Let me see, where is it?
I think that was the last question of the.
Yeah. 9.2. All right, you look at the past IND during the last 10 years. Typically, IND assets can be amortized up to 10 years, straight line amortization, and then you right. So the IND happened 10 years ago. This one has been amortized away totally. But for this one, still 10% left. And for this year, 20% left, so on and so forth. And for the last year, 100% is there. And then you add up the residual value of those research assets together, you get this total amount of IND assets, intangible assets, 13.283. So you need to add this to asset side, 13.2 billion US dollars. And equity, you need to add that back as well, 13.2 billion US dollars. And this is very typical for pharmaceutical companies like Amgen. Amgen is one of the largest biotechnology company. They spend a huge amount of money in research and development. When you look at their earnings, it looks scary. Why is that? Because all those IND are expensed away. You don't see any earnings, but actually they are. Those are long-term assets. Those are long-term assets. And for the earnings, your operating income was 5.5 billion, right? And currently your IND is 3 billion US dollars. You add that back. That's not expense, right? But you minus 1.69 billion. 9.69 billion. That is the amortization. Amortization of that 1.8. Absolutely. You take 10% from each every year. That would be the amortization, which is the 1.69 billion US dollars. That is the true cost of your IND, not that 3 billion. Right? 3 billion is not expense, it's investment. And then what's expense that way should be the amortization. Right? So that's an IND example. And the second one is operating lease. Operating lease is very common for a lot of companies, like retail companies. As long as a company has a lot leased spaces, right? Like a retail company, they have a lot of stores. They do not own those stores. They rent those places, right? So on the balance sheet, what you see is the rent payment each every year. But since that rent actually is based on a long-term contract, let's say Gap company is renting this big store for the next 20 years. Each every year they're paying like a couple $million, right? But since they have commitment to pay that $2 million, it's actually like a debt. They're required to pay that. It's like a debt. So essentially, a lease agreement is a debt, a long-term debt. You see? So although lease agreement is not part of the balance sheet, it's called off-balance sheet item. But in its nature, it's a long-term debt. It's not in there. So if you are missing that part, your debt ratio is underestimated. When the debt ratio is underestimated, everything else will be misleading in your valuation model. You see? If debt ratio is not correct, right? What will be incorrect? Beta will be incorrect. And what else? ROE will be incorrect. Everything else will be incorrect. Especially when that item is big. Right? And for some company, that is big. That off balance sheet lease agreement is big. So what you needed to do when you deal with operating lease is you recover the truth of this large amount of debt from the lease agreement by calculating the debt value, long-term debt value of this lease agreement, which is the present values of future rental payment. That is total value of this debt the company is taking, right? And for the asset side, you have this leasing assets. It's essentially like you are borrowing money, buy this building. A lot of airline company actually lease aircraft, right, from leasing companies. They pay annual rent, but essentially it's like they are borrowing money from the leasing company to buy the aircraft.
So that's pretty much purchasing and depreciating.
Depreciation is not zero.
I mean, to this year.
Yeah.
This year, straight by
Yes, absolutely. So when you hold a long-term assets, the true expense would be the depreciation, not the rent, because the rent has two parts. One is depreciation, the other one is the interest payment. Right. So the adjustment that we need to make is on the data part, we recover this debt value of leasing operating assets. And then we add back the assets. It should be balanced. When you add debt, you add assets back. That's the leasing assets. Leasing debt versus the leasing assets. They equal to each other. And on your EBIT, you add back the lease expense, which is the rent. You add that rent back. That's not true cost. The true cost would be the depreciation of the leasing assets. The example is 9.5. 9.5. Sometimes when we talk about the concept equation, it looks convoluted. You might be confused, but when you look at the example, it's so clear. 9.5. Gap, a retailer. They rent a lot of spaces, and let's say they have a lease agreement for the future years. For the next year, $997 million rent, right? So on and so forth. That's the future rent they needed to pay. And let me see. And the next step is to find the present value of future commitment. It's like first year you need to pay like 997, second year 840 million, so on and so forth, right? And those are future payments that the company need to pay. And then we discount that by using cost of debt, because this is debt, right? You use the cost of debt to do the discounting to calculate the present value, and I think pre-tax cost of debt, 5.5% cost of debt as discount rate. And when you get all those present value together, you're getting the debt value of the leasing assets. So on your balance sheet, on the asset side, you add up $4.2 billion. That's so-called leasing assets. On the right side of your balance sheet, you add $4.2 billion debt. It's like you are borrowing $4.2 billion debt to buy $4.2 billion worth of assets. All those buildings are yours. And so on your balance sheet, this company has zero debt, but it actually has $4.2 billion long-term debt. So when you do financial ratio calculation, everything will go wrong if you exclude this leasing agreement. I mean, it's not in the account. I mean, it's not in the statement, but actually it should, and it's pretty significant part of your balance sheet. And so on your debt, you add $4.2 billion. On your assets, you add $4.2 billion assets. And on the earnings, let's say you do straight line depreciation. So each every year, let me see, 7 year straight line depreciation. So each every year, the depreciation would be $600 million. So for earnings, let's say earnings $2 billion, right? This year, company is supposed to pay this much as the rent, operating lease expense, right? This year, but the true cost should be 601. So your true earnings are much higher than what you actually see in the income statement due to this leasing assets issue. So those are two big items, very common items in a lot of companies. Research and development expenses. It's called a capitalizing process. We need to capitalize expense, because that expense is not expense, it should be the assets. That has effects on your debt, on your assets, and on your earnings. And for the leasing assets, because it's off balance sheet, it's invisible, but we needed to bring it back to your balance sheet. And the magnitude is sometimes is significant. For example, I mean, company has zero debt, right, on balance sheet, but actually no. When you consider this leasing agreement, the company should have like $4.2 billion debt. And on the earnings side, it's underestimated. Earnings are underestimated by like at least like 20%, 25% nearly. Yes.
Do we need to relocate beta this assets?
Beta will be different because you see the debt structure is different. When you do level the beta leveled equals unleveled beta times 1 plus d divided by e times 1 minus t. Previously this is 0, but here it won't. Of course it will affect beta. All right, so those two items will affect everything. your valuation. That's why we needed to make certain adjustment. For some company, you don't see that, that's okay. But for others, they might have significant amount of off-balance sheet leasing items or R&D, then you have to do necessary adjustment. Otherwise, your valuation will be messy. Yeah, because everything's wrong. And so that's chapter 9. And chapter 10, let me see. Chapter 10 is about this FCFE and FCFF. So FCFE, that is free cash flow to equity. It's money belongs to shareholder. If company don't pay dividend, we look at free cash flow to equity. Right? Or company pay much less amount out of the free cash flow, then we still use free cash flow to equity model because that represents the cash flow rise of the common shareholders. Right? And to calculate this FCFE, we start with net income. Add back D&A, that's depreciation amortization, because those are non-cash charge. Non-cash charge, right? And net income is number after those non-cash charge. In order to see the truth of cash, then we add it back. Right. Then minus the investments, CapEx long-term investment, and the change in working capital, along with the long-term project investments. So that will give you FCFE. And FCFF, wait a second, I think I missed something in FCFE. Also need to minus the net changing debt. Net changing debt. Right. FCFF, on the other hand, start with EBIT.
So if, for example, the company issued the stock, and technically they raised the equity, will it gonna affect the change in working capital? Because technically we have more equity.
When company raise that, that's a very good question, right? And that cash is not part of free cash flow to equity because it's not from operation. You see, company is getting more cash, right? On the balance sheet, cash increase and equity increase. And it doesn't affect free cash flow to equity because it doesn't affect net income. It doesn't affect depreciation amortization. It doesn't affect CapEx. It doesn't affect change in working capital. You see? So yeah, that's a good question. FCFF, on the other hand, start with operating earning, EBIT. That is cash belong to shareholders and debt holders. Of course, you apply that 1 minus T, right? It's called operating income. After tax operating income belongs to debt holder and the shareholder. And then you add depreciation amortization minus CapEx. That's net CapEx. And minus the change in working capital. So that's how you get this free cash flow to equity, free cash flow to the firm. And there's a complication. There's a complication regarding CapEx. CapEx may not include all the CapEx. Typically when people say CapEx, that means company buy new equipment, right, in the existing business line. But you should treat merger acquisition as CapEx as well. Because in nature, it's not called CapEx, but it is capital investment when they merge another company, right? So merger acquisition is part of CapEx, right? But what you see in the quarterly report or annual report, it's not called CapEx or capital expenditure, but should be treated as capital expenditure.
So we are going to look to property, plant and equipment, mergers and acquisitions.
And R&D. It's not called CapEx. However, it is capital expenditure. So we need to make an adjustment for CapEx. Yes, sir.
Looking at the effect of our return on investment, should we adjust the CapEx research and development?
Yes.
How would it affect the- No, I mean, I get it, that it will. I'm just thinking.
Yeah, because your initial number was not correctly presented, you see. And we want to recover the economic nature of cash flow and investments, and earnings as well.
Because technically we'll have more earnings if our expenses in the research and development
Yes,
increase.
you will have less earnings show up on your income statement, but your true earnings is higher than that. Right? So here you see there's R&D expense should be considered in adjusting this CapEx, and depreciation amortization also need to be adjusted based on amortization of R&D assets. Right? And here is how you do adjustment on the net CapEx. So yeah, add a little, I want to say, yeah, details, yeah, research and development as well as lease agreement. Both adds some complexity, but for company that has large amount of R&D and large amount of lease assets, you have to do the necessary adjustment. Otherwise, your valuation will go way wrong. You thought everything was correct, but actually, no, not quite, because everything will be affected. Assets, that ratio, beta, everything. Cost of equity including. Right, so for chapter 9 to 10, I mean, if you have concerns on your last couple questions, yeah, I think the last couple of questions from first exams from chapter 9 to 10, then I think the best way is, if you already read chapters, still have some concerns, look at this review first. This review actually help you summarize things together in a concise manner, and then you look at illustration. Illustration is more visually understandable from my point. It's easy to understand from looking at the illustration. Yeah. Any questions? By the way, first exam, I mean, for some of you, will extend to next Thursday, even when you already submitted. Please feel free to make any changes. Right. And yeah. We'll discuss first exam next week.
So technically, that's why the free cash flow is the good, because free cash flow is the good measurement of valuing the company, because it's really hard to manipulate it.
Absolutely, yes. Absolutely. Cash flow is harder to be manipulated than earnings. Earnings are so easy to be manipulated. Now let's take a look at the most popular model that financial analysts are using today in getting stock estimation. That is free cash flow to the firm model. All right. And what is free cash flow to the firm? That is free cash flow belong to shareholders and bondholders. So when we use the free cash flow to the firm as starting point for our valuation, what we are getting here is so-called firm value, or enterprise value, which is the combination of stock value plus bond value. So once you have so-called a firm value, you need to minus the value of the debt to get the value of the equity, and then divide that with total number of shares outstanding to get per share stock price estimation. Right. And there's two versions. One is constant growth model. You simplify everything, right? And assuming that growth rate is a constant number. Or you can do two-stage model. or other model, 3-stage, 4-stage, you name it, also called H model. When company has high growth rate, right? I mean, 2-stage model looks like this. This is the growth, right? Let's say for the first 5 years, I have high growth rate, right? And starting 6th year, right, it declined too low, 2.5%, right? So that's 2-stage model. Some people say, hey, for next 5 years, it's going to be high, but we have 3-year transition, it will go lower, right, to 9%, and then to 5% years, and then 2.3% forever, like a 4-stage model, so and so forth. And some people do like H model. H model is like, okay, in 10 years, it will go down to low number, but right now it's high, but there's a transition period between 50 or 10 year, right? A linearly declining growth rates, that's called H model, right? So this is called H model, a 2-stage, or 3-stage, you name it. You can make it 10-stage, but in most cases, 2-stage will be sufficient, or 3-stage will be great too. Yeah. And when you do 2-stage, 3-stage, or H model, it's easier for you to put everything in the spreadsheet. So you can see very clearly, right, how those earnings changes, how you apply those assumptions into those numbers. And I will demonstrate one examples, yeah, in chapter 14. This is chapter 15. On how to build up the Excel spreadsheet. Let's go directly into example. Let's say evaluating a food product division in a publicly traded company, right? And the rationality to using the free cash flow to the firm model is the division is in steady state. Large player in stable market with strong competition cannot be expected to sustain high growth for any length of time. This is a constant growth model. Division does not carry its own debt, and the entire division is up for sale. That's why we need evaluation. Right? Now here's some background information. We wanted to know the revenue, right? Revenue of the division, earnings, EBIT. Earnings before interest and taxes, EBIT, and capital expenditure, free cash flow. You have to, get some information about the capital expenditure, depreciation, amortization, right? 550 depreciation. Working capital as percent of revenue has averaged 5% between 1993 and 1994, right? And working capital increase, 350 million in 1994. So here it offers one feasible way for you to estimate future change in working capital. It's based on sales. It's based on sales. If you already have the estimation of sales, then you look at what's the percentage of working capital, right, of sales in the last 5-10 years. And once you have that percentage, you can apply this percentage into future year's sales to get a future working capital. Once you have future year's working capitals, the difference between years would be change in working capital. I will show you how to do that in Excel spreadsheet. It's pretty straightforward process. And then you look at the beta. And the company, the unit itself doesn't have beta because it's part of the company. So here you use this bottom-up approach. You look at a comparable company tradable on the market to see what a beta is. Beta is, and here is a 1.5. And the average debt ratio for those companies 23.67%. So this is the raw beta. It's leveraged comparable beta, right? And here is other companies' debt ratio, right? And cost of debt at the largest of these firms, probably 6.5%. And the tax rate is about 36%. Cash flow to the firm is expected to grow at 5% in the long term. Constant growth assumption. Yes, sir. Any question?
I wanted to invest in a company. Right now, the AT&T is spinning off the Warner
It's a very good valuation project, I think. Yeah. It's part of the company, right? So this offers you a great example on how to evaluate a business unit within a publicly traded company. Yeah, pay attention to this. Right, and we discussed the detail of that one. And once you get those numbers, you want to build a spreadsheet. Right? You have the current number. All the numbers are past number. What do you need in your spreadsheet is next year's number. Right? You have past year number. How do you get next year's number? Multiply that with 1 plus the growth rate. Right? And then you capital expenditure minus depreciation. And then change in working capital. And then you get a free cash flow estimation. Free cash flow estimation. Right. And then you look at the beta of comparable company. 1.05, unleveraged. Unleveraged, because this business unit has zero debt. So you need to use that unleveraged beta, right? And you got a cost of equity estimation. And the pre-cost of debt, you look at comparable companies' cost of debt. Because this company doesn't have debt right now, it doesn't mean the future will not. You may take debt, so you take that into consideration, right? Look at the comparable cost of debt and after-tax cost of debt as well. And then you look at debt ratio, 23.67. Why would you do that? Right now, a company has no debt. When it spins off, you would expect this company become one of the average company. Average company takes this much debt. Although right now it's zero, but it's very likely that this company will become average. Industry average, right? That's a reasonable assumption. You might say 50%. Why 50%? You say 23%. That's reasonable because every people in this industry is taking that amount of debt. I mean, your debt could be higher but lower, but this is the best guess. And here you got the cost of capital estimation. You have the weights, right? You have the weights. You have the costs of equity and the debt that give you weighted average cost of capital. That's discount rate. And this is the cash, free cash flow to the firm. This is WACC, and this is the growth rate. Will give you the estimation of the firm value, 13.6 billion US dollars. And let's take a look at another example for two-stage model. Federal department store, pretty old department store. The rationale is the earnings before interest taxes at a company, which amounted to $500 million, was still well below EBIT in 1988, 628. So the company went through a distressed time, and right now you would expect the company will go through a strong recovery and expansion. The economy is expanding in late 1990s. Earnings are expected to grow at a rate slightly above stable for the next 5 years as company recovers. So that's a pretty reasonable assumption. 5 years, strong recovery, which will bring high growth rates during that 5 years. And the leverage in 1994 was still significantly above desired level, largely as a consequence of leverage buyout in the late 1980s. It was anticipated that this debt ratio will be lower gradually over the next 5 years to acceptable level. When you say acceptable level, what would that be? That would be the industry average. Industry average would be so-called acceptable level. And here's more information about earnings, EBIT, CapEx, depreciation, sales, working capital as percentage of revenue, and tax rate. Now here is more information. I mean, you need to pay attention to this because when you use two stages, you're going to apply, okay, first of all, different growth rates, of course, right? 5-year high growth time period, you expect high growth rates of 8%. And for the stable growth time period, you expect a low growth rates, 5%. That's difference. And the second difference is cost of equity is going to be different. Cost of debt would be different. Therefore, that WACC would be different. Right? And previously, beta is 1.25 for high growth time period. But when company getting into this stable growth time period or constant growth time period, that beta is supposed to be lower. And you would assume that beta will move to 1. In this case, cost of equity will decline because beta will be lower. And the second, your cost of debt will be different. Let me see. Cost of debt during the high growth time period would be 9.5%. But for the stable growth time period, because company becomes less risky, cost of debt should be lower. Right? And you make assumption on debt ratio during a high growth time period. Because company needs to grow, of course, company needed to borrow more money to generate growth. I mean, company had to invest, right? You have to borrow money, invest to generate growth. So we assume a higher debt ratio. But in the stable time period, that ratio should be lower because company no longer need that much debt to support high amount of reinvestments. So for two different stages, we should have different assumptions on beta, cost of equity, the capital structure, and the cost of debt. That lead to different WACC. So here's the spreadsheet. You start with EBIT, right? Then you apply high growth rate for the 5 years. And 6 year is the so-called first year of the terminal time period. Right? And you apply the low growth rate for year 6. Right? And same thing for capex, depreciation, and change in working capital. And then you get estimation of free cash flow to the firm. And then you discount every cash flow for during this 5-year time period using that high WACC. And then for the constant growth time period, use this number divided by R minus G. That R is low WACC. That G is a low G. And then discount back to today to get the present value of the terminal value. Terminal value is future value. Now you see cost of equity, cost of capital, right? And then free cash flow in terminal year, terminal year. And then you calculate free cash flow in terminal year, and then calculate the future value of terminal value, and then discount it. Terminal value is $6.4 billion. And then you continue to discount that to get the present value, which is the $3.9 billion. And the present value of free cash flow during the first 5 years is this much. And then you add them together to get a value of the firm. And then minus the value of debt, you get the value of the equity. Divided by number of shares outstanding, you get the value per share. Now, before we leave the classroom, I wanted to spend about 10 minutes to demonstrate one problem solving in chapter 14, free cash flow to equity. Let me see. When you do chapter 14, it's very similar to chapter 15. Just the way that you get a free cash flow to the equity is different, slightly different, but the Two-stage model, constant growth model is essentially the same. Let's take a look at chapter 14, number 3. Number 3. Chapter 14, number 3. I'm sorry? Yes. The way that you build a spreadsheet will be very similar to the question exam 2 actually, yeah. Chapter 14, question 3. Okay, company says chemical, yeah, other stuff, Ecolab. Actually, that company headquartered in Nashville, I think. Ecolab. It reported earnings per share $2.35, 1993. Expected earnings growth 15.5% a year, and a 6% a year after that. So high two-stage, 15.5% high growth time period, right? For 5 years. At the beginning is the 6th year, there will be constant growth, 6% constant growth. Capital expenditure per share $2.25, depreciation $1.125 per share. Both will expect to grow at the same rate as earnings from 1994 to 1998. Working capital expect to remain 5% revenue. Revenue was $1 billion in 1993. Expect to increase 6%. 6% high growth time period, right, for sales. 4% a year after that. The firm has debt ratio. Plan to finance future investment needs using debt ratio 20%. The stock was expected to have a beta of 1 for the period of the analysis, and the T-bond rate is 6.5%. 3 questions. Assuming capital expenditure depreciation offset each other after 1998, estimated value per share. It is a realistic assumption.
Yeah, but then the company.
So if company do not invest, we assume that growth will be 0, right? And here, if capital expenditure equals depreciation amortization, the net investment would be 0. So the growth will be 0, which is inconsistent with the assumption that the growth will be like 4% after year 6. All right? Assuming that capital expenditure continues to be 2% of depreciation even after 1998, estimated value of per share. That's reasonable, right? CapEx to 100% of depreciation. Company is continuing to invest. It should generate a growth. All the value per share have been if company had continued to finance new investment with old financing mix. Financing mix actually changed. So let's take a look at the Excel spreadsheet. All right, so first of all, for two-stage model, you have year 0 and a 1 to 5. That's a high growth time period, and year 6 is the beginning year of the terminal time period. Right, so here is year, right, and then you add a column. That is the growth rates. Right. And here the starting point is this net income on a per share basis. So this is the year 0 net income. and then you work on this cell, which is 2.35 times 1 plus this G. All right. Once you have this, you can copy this. You can copy this all the way down to here. But starting 6 years is different, right? This one will be 1 plus 6%. All right. So you got the net income estimation. And then capital expenditure. Right, it's the same. It follows the net income growth rates. And then the depreciation. Right? Depreciation. So here, I'm answering question 1, assuming this capital expenditure equals depreciation. And I make the comments in case I forget about that. Sometimes you may want, hey, why that one? It's 2.45. Where does that number come from? You make certain comments to remind yourself. Right? And then revenue. Why do we need the revenue? Because I want to estimate changing working capital. I add a column of revenue, current revenue. Revenue growth is different from earnings growth. 6%, right? 6% each every year for the first 5 years, and then 4% thereafter. Once I get this, I estimate working capital, which is a 5%. 5% of sales. So all those are working capital requirements. And then changing working capital equals first year working capital minus last year working capital. The difference would be changing working capital. You see? Once you get one cell, you can copy all the way down to the end. Right? But this has a little problem because I'm doing calculation on a per share basis. You see, this revenue is total revenue, it's not on per share basis. Therefore, this working capital, also in millions, is total working capital, right? And then this change also total. So to be consistent, I have to get the change in working capital per share. Number of shares 63 million, right? And here's debt ratio, 20%. Now here's changing debt. Changing debt equals capital expenditure minus depreciation minus plus changing working capital per share and multiply by 20%. It simply says the new reinvestment will be financed 20% by debt, 80% by equity. And then I get this free cash flow to the firm, to equity. And after that, I calculate the present value of each every free cash flow to equity during the first 5 years. And I calculate the terminal value. This is terminal value. It's already discounted. It's present value of the terminal value. M17, that's this number, right? Divided by R minus G, WACC, right? G is 0. That's why you don't see minus G here. Because they cancel off each other, right? The capital expenditure, depreciation, amortization cancel off. G should be 0. And then I get stock price estimation. Terminal value plus high growth cash flows value. Right, so that answers question 8, $31.85. And then B. And then B, I assume different assumption. Capital expenditure, 200% of depreciation amortization. All right. And in this case, this free cash flow is different. And also this growth rate will generate 6% growth rate. Previously 0. When a company invests more, it will have smaller number of this free cash flow. Previously $5, right? But it will not grow. But this one is small here, but it will grow. So the terminal value will be greater. Terminal value would be 29 instead of 24. That's because company invested, it generated actual value. That gives you $37 estimated stock price. Yes.
Assuming that the company did pretty good on their previous return on investment capital, and whenever they do the capital expenditure, then based on their track record, their value should increase.
Yes.
Right. But if that's what, for example, like the Facebook case. They spend a lot of on the research and development for the metaverse. They spend $10 billion, and that should be treated as the capital expenditure.
Yes.
You will treat it as the
Expense in the balance, in the income statement.
They look at the different evaluation. However, they have the return on investment capital at about 8% or 9%. The value technically should increase.
Yes. But everybody already see that. So it's already being adjusted. When you see Facebook stock price, it's already reflected. Although you don't see it in the financial statement, but everybody else who are competent financial analysts, they already done the adjustment. So Facebook stock price today that you see, it's already there. It's already being adjusted. Research development expenses. But if you're amateur, you may miss that. You see, that's the point. And then here we have another assumption, capital expenditure 200%. What else? What's the difference? Oh, debt ratio, yeah, 5% instead of 20%. You see? So this offers you a basic structure for two-stage model. No matter it's free cash flow to the firm or free cash flow to equity. And you do first stage, second stage. Then you do terminal value estimation, and also you need to do the discounting, given you know the discount rate. And sometimes you need to build a side table to calculate the cost of equity or cost of the capital. Right? But once you put everything together, it should be like this. It should look like this. But sometimes, there's some variation depending on the way that you estimate free cash flow to equity. And another way to estimate free cash flow to equity is, or free cash flow to the firm is, let me see, EBIT, 1 minus T, right? You start with that. Let's say you are doing free cash flow to the firm, right? And then you need to find like a CapEx, right? Or D&A, right? Working capital, something like that. But question, sometimes you don't have that information at all. And another way is to find the reinvestment. Reinvestment rate. Let's say EBIT is 100 after tax EBIT, and somehow you figure out this reinvestment rate is 50%. And then this free cash flow to the firm is just equal to this times 1 minus reinvestment, right? Just the one step. But how do you figure out this reinvestment rate? There's no capex, there's no depreciation amortization. Well, previously I asked you to make notes on how you get this G estimation. G equal to R and R times ROE. And then here you might need to figure out that reinvestment rate. And this reinvestment rate equals G divided by ROE. I think there's one problem, require you to do something like this.
Yeah, that was.
That's the second way. Second way for you to do the Excel spreadsheet. All right. I think you should be able to address first 3 or 4 questions. Using cash flow based model. Using cash flow based model in your second exam. So after you done first exam, it's time for you to directly get into your second exam. Practice those problem solving by using the spreadsheet like this. It may not be exactly the same, but it will be a similar structure like that.
I think it'd be easier that way.
Okay. I have 3 other examples for you to look at. Question 5 and question 7. And also have video explaining the entire process. All right. Check the ground like, hour ago. I think it's still good to go if you want to go home. I think, we can stop here so you guys can get home a little earlier. Tomorrow, no school. All right. Any questions, email me. Or you can set up a Zoom meeting with me. And make sure, you submit your first exam and do any change that you want. For exam, I will look at it next week. Which one?
What do you call it? Like the computer one for the professors?
Which one?
That's a
Computer lab?
Not the computer lab, the office.
You mean
On the north side.
on the north side?
Yeah, where your offices are.
Yeah.
The office.
I don't bring the key today. It's just my office, but
Oh,
I see the door was open.
it was locked when I went.
Okay. What time was that? What time was that?
Right before I came here.
Okay. Then you need to find those guys tomorrow morning.
I'll go tomorrow.
Yeah.
basically all the companies, normally the financial institution, they evaluate the price of the company when the earnings release.
Yeah.
They evaluate them instantly, right? And then adjust the price target.
When earning released,
Mm-hmm.
you will see stock price change a lot.
Yeah, I mean, I've seen that. I see that every day.
And
Right now, it's
in the normal day, it doesn't change a lot, but on the earnings release day, it changes a lot. And here's why. Let me see. Typically, people talk about if company beats consensus. What is consensus? Consensus is yesterday's stock price. That consensus includes estimation of sales, earnings, and everything. Mostly sales and earnings. Right? And then when company release earnings, the number may match that number. Right? For example, company estimate sales. I mean, not company estimate. People on the market estimate sales gonna be 100 billion. Right? And earnings, right? Net income is gonna be like 15 billion. And it is these information, these opinions, built into yesterday's stock price. Let's say $350 per share, because that stock price reflects what the people think. Now today, a company actually says sales is 110 billion, and the net income actually 17 billion. So it's a positive beat. Stock price will go up a lot. And here's another scenario. Company has net income, sales actually is 98, 2%, less than what market think. And this net income is like 14.2 billion. What do you think? I mean, as far as estimation goes, 2%, would that be huge? I mean, here 0.8 out of 15. I mean, visually it's not that huge, right? You would say, hey, maybe stock price will decline by 5% because earnings are lower, right? I mean, 0.8, 15 is about 5%.
yeah, but on a growth model, on
Right?
the terminal
It's like
value,
5% less than what people think. This 2% less than what people think. And in a lot of scenarios, stock price will tank by like a 20-30%. It's called it's called the company actually not miss company's goal. Maybe company last year's sales is like 90 billion. Last year was 10 billion, right? You see huge improvement. I mean, when company report, they say our net income increased by 40% plus. Our sales increased, right, almost 10%. That's exciting, good news, right? Then why stop down by 20%? It's all because yesterday's price incorporates high expectation.
yeah, because we multiply in that in perpetuity, and that changes.
And
the,
this expectation actually will extend it to future years, which creates this stock price. You see?
because we're looking at the present.
That's
value,
why
future
sometimes you
value.
see like just miss a little bit. And why stock price tank so dramatically? And sometimes you see, hey, that piece of good news isn't that great, but stock price shoot up by like 100%. And sometimes investment bankers actually they trade, they utilize this for their trading purposes.
And that's what I
Let's
usually-
say something like this happens. I mean, people think, hey, maybe down by 5%. If it's down by 8%, that will be more than enough, right? But some investment bankers are gonna do really crazy thing. They're gonna do short sell, very aggressively, push down by like 20-30%.
That's
And the next day, people say 20-30%, that's enough. No, another 10-20% decline maybe.
and then they just I've heard
And
about
for
that.
the company that continues to beat continuously, not just the one quarter, like last 2 years, 8 quarter, continuously beat, stock price may increase by folds. Yes.
That what happened to the Google, the Amazon today. See how much that was a great jump on Amazon.
I mean, for Facebook, you look at earnings, it's good. Revenue, good.
Um, what I'm seeing right now, I'm looking at the level of market at the level two.
Yes.
The level two is very active right now.
Uh-huh.
What I'm guessing is within all the speculation, the hedge fund can just speculate a lot. You just
Of
just
course.
move the price down all the way as you can.
Of course.
Spend all the liquidity, and
Yeah.
then buy the calls, and then capitalize on the calls.
But look, I mean, it's not just one or two hedge fund can do things like that. I mean, Facebook, how big is that?
200 billion
No.
overnight.
I mean,
It dropped 200 billion.
I mean, their market value was like almost
Almost
900
900 something. Yeah.
billion,
Yeah.
right? It's not something that one investment bank or one hedge fund can accomplish. You see, it's a group of people. Yeah, it's a big group.
So today, Amazon, from 2,776 to 3,258. So just like today. Overnight, that's earnings as well. So I've never seen a market so volatile as this.
Of
right
course, of course. People see. I mean,
now.
people see.
I was looking at the same thing, and I see the same levels in 2008. How the volatility spikes, it spikes to 40, then it drops to 20. It spikes to 40, it drops to 20. The volatility index.
That's crazy, huh? Yes. Yes.
One question of the homework.
Yeah.
I'm not sure.
Which one?
12, separate question 12. Did you remember that you say use only the 7% of the market? Because they have 5% and 7% of the market.
Uh huh.
But when I see the rate you have 0.6 and get 0.67, I can show you. I have my computer.
Yeah, yeah, yeah.
You have
What chapter is that? Hmm?
chapter
8?
I already submitted, but I want to fix the things that I think that I am wrong.
Okay.
And that is the reason I say you have
Number 20? 18?
12. Question 12.
Oh, 12. Oh, I see, I see, I see. Yeah, it's a little complicated. Regression first, yes.
Regression first.
Beta 0.7385, right? Yes.
Intercept I get 0.0147.
Yes.
And this is in the regression.
Yes. Yes.
Right?
Yeah.
Now, my 6 month, my 6% from the TBU give me an expected return of 0.6.
No, 7.5%, right? The question says.
I don't know what I get, how I get that.
In the question, I think. The question says 7.5%.
The TBL is 6%.
6. Number 8, and this is number 12.
Number 12.
Number 12.
You're in number 8.
Oh, yes, 6%. That's right. Yes. Yeah.
When I use this one, it's 0.6%.
Yes, that's right. Yes.
But I'm going to send you this one I already answered in the other one because this is my scratch thing. I already sent it in a new.
Okay, I see. Your calculation isn't right.
This one isn't right. That I know.
Yeah, click on this.
And this one?
Yes. What's C43?
C43 is my 6%, 0.6% from the TV.
Oh, you need to add that 5.5% here. The risk premium. Where's your risk premium? Equity risk premium.
7.
No, it's not that one. That's not equity risk premium. Actually, I think
Missing one.
you might want to add equity risk premium 5.5 or 6%. Yeah. So here you're getting 0 equity risk premium. That's why you are getting 6%, right?
So this one, we are going to
Make this like a 5.5%, for example. This frequency, yeah.
0.05.
For example, yeah, you can make this 5.5%. Yeah. For answer like this, use a percentage. Keep 2 decimal points. Yes. Have a good night.
That I can use the 5%, the percentage, and yes.
Keep 2 decimal points.
So that would be my expected return.
Yes. That will be the expected return. Yes, sir.
For the regression, actually, yeah, for the regression, for the beta, you said we're doing a 12-month target price. So if we do the, analysis, it's fine to go back 12 months to 1 year of history, or is it better to do 2 years?
1 year is good.
1 year is good, just as we're doing 12 on 12?
Yes.
Okay, that's what I want to say. Simple. Thank you.
And I get that the different results in the bottom one. So there's another question. I work every day until 5 a.m.
Oh.
Very late, I was wondering if you after that time, like I get at home at 6.
Yeah.
I can request a Zoom meeting that late.
Friday, how about like a Sunday afternoon or Sunday evening?
Okay.
Wait. Sunday no good. Monday, any time on Monday?
Yeah, like after 6 p.m. I can. Because I go at 8 a.m. and I leave at 5:30.
Okay. Yeah. Send me email. Yeah. Friday probably not good for evening, but Monday would be good. Tuesday I have evening class. Tuesday is no good. Either Monday or Wednesday, I guess.
Okay, Monday or Wednesday. The reason that I'm asking you is because I want to work with
I know.
the ladies in
Yes.
the project.
Yeah.
And we are going to have questions.
Mm-hmm.
And really, I'm stuck with the first part.
I see. You will do good. Don't worry.
But something that I have, I work until I get it.
Okay.
Doesn't matter if I can spend 40 hours in.
I know.
You can ask this lady that she told me on the 2 a.m.
Oh, you do good.
Someday.
Yeah. Yes, absolutely.
Thank you, Professor.
You too.
I have to bring you home, guys.
I will email you about everything.
Okay. Appreciate it.